Hey everyone, and welcome back to Financial Market Insights for Traders, the podcast that breaks down complex finance topics so traders and investors like you can make smart, strategic moves in the markets. I'm your host, Sophia, and today we're diving deep into a topic I get asked about constantly, especially by newer crypto investors who feel like they've missed the boat or just can't keep up with the pace of change. Today's episode is all about DeFi, staking, and yield farming. These are powerful tools that go far beyond just buying and holding crypto, but they're often thrown around like buzzwords without a clear explanation of what they actually do, how to use them, or what the risks are. So, whether you're brand new and just getting into crypto investing for beginners, or you're looking to build a smarter crypto trading strategy, this episode is for you. We're going to keep it real, cut the jargon, and walk through everything you need to know to start using these tools safely and effectively. Let's get into it. What exactly is DeFi? DeFi stands for decentralized finance, and what it does, in simple terms, is remove the middleman. Instead of using banks or brokers to lend, borrow, trade, or earn interest, DeFi lets you do all of that directly on a blockchain using smart contracts. Smart contracts are self-executing bits of code that automatically run when certain conditions are met. They live on public blockchains like Ethereum, so they're transparent and accessible 24/7. And what can you actually do with DeFi? Let me give you a few examples. You can borrow crypto without going through a credit check by putting up collateral like ETH on a lending protocol like Aave. You can lend your crypto to others and earn interest using platforms like Compound. You can swap tokens directly with other users, no account needed, using a DX like Uniswap. So why does this matter? Because for the first time in financial history, these kinds of services, borrowing, lending, trading, are accessible to anyone with an internet connection. That's a massive shift in power. No institutions, no gatekeepers, just code. But let's not gloss over the risks. DeFi is still early stage. A lot of platforms aren't audited. Hacks happen. Code gets exploited. So the upside is there, but so is the risk. And that's why things like crypto risk management techniques matter more than ever. More on that in a bit. Staking, the simpler way to earn. Now let's move on to staking. And if DeFi sounds a bit too advanced for now, staking is probably where you'll want to start. Staking is how you earn passive income by supporting the network of certain cryptocurrencies that use a proof of stake, or POS, model. So here's how it works. You lock up your coins, say, Ethereum or Solana, and they're used to help validate transactions on the network. In return, you get rewarded with more of that same crypto. It's kind of like earning interest, but instead of loaning your money to a bank, you're contributing to the operation of the blockchain. Some of the most popular coins for staking in 2025 include Ethereum, Cardano, Solana, Polkad, and Avalanche. Now, how much can you actually make? Typical returns range from 4% to 12% annually, depending on the network and provider. Ethereum, for example, might give you 4 to 5% per year. Solana might be closer to 7%. And of course, there are services that let you stake without having to run your own node, places like Lido, Kraken, or Coinbase. But staking isn't risk-free either. You've got the risk of slashing, where your stake is penalized if your validator misbehaves. Some platforms have lockup periods, so you can't just withdraw whenever you want. And there's always market volatility. So even if you're earning more tokens, if the price of those tokens drops, your total value could shrink. Also, quick tip. Always use a secure crypto wallet for staking. Don't leave your funds on an exchange. Use a hardware wallet or a reputable self-custody wallet like MetaMask or Trust Wallet. Yield farming. High risk, high reward. All right, let's talk about yield farming, also known as liquidity mining, the most complex but potentially most rewarding of the three. Yield farming involves providing liquidity to a DeFi protocol, usually a decentralized exchange, and earning rewards in return. So, for example, you might supply an equal amount of ETH and USDC to a Uniswap liquidity pool. Those assets are used by other people to trade. In return, you earn a share of the trading fees, and often, You also receive bonus tokens like Uni or Cake. Some farmers take this even further and compound their earnings, or jump from pool to pool chasing the highest yields. This is where things get advanced and sometimes reckless. Because, yes, the returns can be crazy. We're talking double digit and even triple digit APYs in some cases, but that usually comes with serious risk. Let's break those risks down. You've got impermanent loss. That's when the value of the two tokens in your pool diverge in price, causing you to lose value compared to simply holding them separately. You've got smart contract risk. Bugs or vulnerabilities in the code could allow a hacker to drain the pool. And you've got rug pulls, when developers pull out all the funds and disappear. So if you're a beginner, do not go all in on the newest farm with a cartoon mascot and 3,000% APY. Start small. Use reputable platforms like Yearn, Curve, or Aave. And remember, higher reward always means higher risk. Compare and choose what fits. Let's quickly compare these three options. DeFi is broad. It lets you access a full range of financial tools. Staking is simple and good for passive income. Yield farming is powerful, but complicated and risky. You don't have to pick just one. In fact, the best crypto investors mix strategies. A little staking here, a little farming there, and maybe some DeFi lending on the side. But they also take the time to learn. And that's what you're doing right now, so props to you for that. Crypto strategy tips and getting started. Let's talk about what to do next, because information is only useful if you act on it. Here's a quick 5-step plan for putting this knowledge to work. Research before you buy. Use tools like CoinGecko and Token Terminal. Ask questions like, what's the use case? Who's building it? And is the code audited? Use a secure wallet. Don't leave funds on exchanges. Use cold storage if you're serious. That's my go-to secure crypto wallet advice. Start small. When exploring DeFi or yield farming, test with amounts you're willing to lose. Track your gains and taxes. Yes, most countries tax staking and farming income. Look up, is crypto legal in your country, and stay compliant. Practice before you play big. Try trading strategies on a demo or beginner-friendly platform first. In fact, if you're looking for a great place to learn margin trading in a less overwhelming way, check out crystalballmarkets.com. It's a solid platform for beginners to try crypto trading with leverage while keeping risk under control. Again, that's crystalballmarkets.com. Definitely worth checking out. And if you want to go even deeper, listen to the Crystal Ball Markets podcast. They explain everything from how to research altcoins to identifying the best cryptocurrency to invest in 2025. It's one of the most beginner-friendly crypto podcasts out there. Final thoughts. Crypto investing today isn't just about buying and hoping for the best. If you want to grow your portfolio, tools like DeFi, staking, and yield farming can offer real opportunities. But here's the truth. None of them are magic money machines. They're just tools, and like any tool, you need to know how to use them properly. So stay curious, stay cautious, and stay consistent. That's it for this episode of Financial Market Insights for Traders. If you found this helpful, be sure to subscribe and share it with someone getting into crypto this year. And don't forget to check the show notes for links to platforms and podcasts I mentioned today. I'm Sophia. Thanks for listening, and I'll catch you in the next one.